I just want to share a short intro on the contribution my firm, HIP Investor, is making to the effort of investing to achieve a more resilient portfolio and a better future world. So, standard disclosure. So we have a rating system to bring light to intangible values and risks, so things that can become opportunities or risks in your portfolio. And we look at the products and services of a company, so similar to what Ken Laughlin was talking about, the percentage of revenue coming from forward thinking or new economy types of products and services. We look at operating metrics and management practices across these 5 pillars of health, wealth, earth, equality, and trust. So they're outcome-focused, results-based metrics. So examples of metrics would be customer satisfaction, diversity of the board, legal exposure, and of course, carbon efficiency. So we rate companies which issue stocks and bonds, and countries, municipalities, agencies which issue bonds, similar to the green bond principles we heard about. This is an example of City of San Francisco rating across health, wealth, earth, and equality, and some examples of metrics. And for those of you with some portion of your fund in mutual funds or ETFs, we quantify the CO2 exposure based on the top 200 holdings, the carbon tracker holdings. So this is a before and after portfolio for the Global Conservation Network, and from Ani Byers Group, who we heard from earlier, is a fossil-free investor as of an hour and a half ago, I guess maybe 2 hours ago now. And so the way that we're approaching it is the risk of the companies in terms of the weight the mutual fund or ETF is holding in the company, and then the percentage of that company in your portfolio. So in this example, we reduced, for Global Conservation Network, we suggested a diversified, time horizon appropriate, risk appropriate portfolio that reduced their carbon exposure by 70%. So they're already, this is the risk and return and climate risk profile of the GCN portfolio, where they were currently, the proposal, and then also a benchmark, a sort of standard basket of companies. And I'll just end by saying we also, in concert with Fossil Free, Go Fossil Free and 350.org, we released a fossil free white paper earlier this year, or actually it was last year. And in the appendix of the white paper, we show a collection of investments which do exist, which can compete with current portfolio choices in providing market rate of return, income, liquidity across all asset classes. So in stocks, we included Trillium and Boston Common Strategies, who are here today. In stocks and bonds, we have Leslie Samuel Rich's firm, Green Century. In real assets, we have Solar Mosaic and many others. So check that out. And these are investments outside of fossil-based assets to promote diversification for your funds. So this leads to our next panel on reinvestment, gaining more than alpha. We have a group of experts to share their leading work, creating opportunities for investing that value natural systems and the future health of our communities. Welcome them.
Okay. Hello, everybody. It's great to see so many people here today. And just to give you a sense of what we're going to do to kind of take us to lunch is look at a slightly different question than what we've been looking at this morning. So if I'd say this morning, we looked primarily at investments that, if they're successful, would intensify the negative impacts of climate change, and then how do we avoid investing in those? We're looking at a different question now. We're going to look at what investments, if successful, will minimize the impacts of climate change. So essentially the good investments that we would want to seek out and see them be profitable. I think, as Bob Massey put it, this is our desire for a new economy. And so what are some of the solutions that will be a part be a part of that. Just one thing I want to do to kind of put in context this discussion of reinvestment. We are at the California Divestment Forum. So I think it's worth maybe just taking note that 10 years ago, there was an interesting experiment in reinvestment, and that was done at CalPERS and CalSTRS. So at the time, Treasurer Angelides did what was the Green Wave Initiative. Some of you may be aware of that, but that was committing $1.5 billion really to environmentally responsible companies and then also to private investments in environmental technologies. And I think one interesting question to ask is, now 10 years later, in 2014, what would a second green wave look like if it occurred amongst a broad range of institutional investors? And what are the new tools and the new investment opportunities that didn't exist in 2004 that invest today? So that's really what we're going to dive into. I'm hoping to kind of have an optimistic conversation, but obviously a realistic conversation in terms of what we can do. We're really going to look at a few different asset classes. I know different investors have different focus, but we want to look at bonds, we want to look at public stocks, and then we also want to look at private investments. And to start things off with bonds, we have Amelia Timbers here today, and she is the Energy Program Manager at As You Sow. And really interesting background. She's worked previously at the Massachusetts State Treasurer Office and also at the Federal Reserve Bank. Great experience, JD, an MBA, a Master's in Environmental Law. So brings a lot of experience in the table. And currently at As You Sow, she's working promoting sustainable policies in the energy sector, focusing on climate change, coal risk, and sustainable investment. And what I think I'll actually do is maybe, Amelia, if you start now, and I'll introduce each panelist as they make their opening remarks.
Thank you, Will. Can everyone hear me? Sounds good. So as Will said, I'm the Energy Program Manager at As You Sow. And as part of that work, we support divestment campaigns and collaborate on projects with 350, which is what brings me here today. And in working on divestment, we hear from boards and administrators this question of where do we reinvest, which is particularly pertinent for institutional investors that have very strictly prescribed risk thresholds and investment guidelines. It's my feeling that the equity side of reinvestment gets more headlines, or at least recently has. You've got really exciting companies out there, Teslas of the world, Solar Mosaics of the world, doing great things. But recently, there's been more headlines around green bonds. And I know that because I have a Google alert, and I had to put it in a separate folder because there have been so many alerts lately. But I also know that because I was at the Massachusetts State Treasury, which issued the first green bond, the first state to issue a green bond, which I'll talk about more later. So I guess just to start out, what is a green bond? A green bond is a bond that invests in the low carbon economy. And that's a broad definition, which we can talk about why that's broad and the various efforts to narrow it if we have time. But it's a bond that funds green projects, sustainability projects. And it's issued by people who typically issue bonds, such as governments, corporations, development banks, pretty standard sources. In fact, I believe we have a potential issuer here, Santa Clara Water District, thinking of you and your potential green bond future. But yeah, so it's in many ways a bond, just redirected to green projects. Let's see. So green bonds are particularly attractive to me and inspiring. I hope I can add to the optimism of this discussion because they address the climate crisis in a very effective manner. We have a really big problem. Someone mentioned earlier the need to move $1 trillion a year into sustainable assets. And in general, so far, what's happened on the equity market affects about, I think it's 60 trillion assets represented by equity. There is nearly 80 trillion assets in bonds. So we really want to activate that larger portfolio and reach the institutional investors that hold it. So the scale, green bonds responds to the scale of the situation also in that they're quick, relatively quick to deploy. You can issue a bond, put it towards a project, and be hiring people to work on that project within a year if you're fast about it, and that allows capital to be raised fast. And in that sense, it responds to the urgency of the climate issue. Equity, of course, requires a company to grow and flourish. So bond markets respond to the need to raise money fast. And a lot of people are comparing green bonds to victory bonds from World War II for this particular reason. They really serve the urgency of this war we're fighting on carbon. Additionally, they match the projects that need funding. Solar projects, renewable projects, various projects like that have large upfront costs and then pay modest, gradual returns over time. That's a better fit for a bond, which does the same thing, than perhaps private equity that needs larger returns faster, perhaps. Additionally, it is a better fit for the investors we want to activate, which I think I mentioned earlier, institutional investors. Christina Figueroa, the UN secretary, recently called for institutional investors to really mobilize their assets. You need safer assets than perhaps a fantastic and exciting startup. Many institutional investors won't be able to invest in something like that where they could buy bonds, which something like 90% of the bonds that have been issued are investment grade. Let's see. And in general, to that point, they tend to be lower risk. So in a lot of people, I think still, despite our best efforts, think of sustainable finance as a little risky. But green bonds are an answer to that risk, saying, here's this alternative option for you. Some facts about the size of the green bond market. Since 1994, there's been approximately $346 billion in issuances. That's gone approximately 80% towards transportation and 20% towards renewable energy. The green bond market is growing very rapidly, and that is part of why I'm so excited. This is a vehicle that could get us where we need to be in terms of moving that money. And in 2012, there had been $2.43 billion in green bonds issued. 2013, by September, there had been $3.7 billion. But by December, $10 billion, which is why my email box was blowing up. It was a very exciting fall, and it's a great time to be talking about this because at some point, I'm not quite sure what triggered it, but you have very big players in the room now. The biggest banks in the world are interested in this asset class and find potential in it, which is just completely thrilling. Additionally, so far, we're 20 days into January, there have been over $1 billion in green bonds issued so far, so we've already gained about 10% of last year's value. This early in the year, it's looking good. So I guess just to give a little context, additionally, when I was at the state treasury, in the debt division I was a procurement manager for investment asset products. And the state treasury was considering, green bonds. Bonds have had a tough time this year, particularly with Detroit and other issuers injecting a lot of risk into the market, which is typically quite stable. So at the treasury, they, were looking at different ways to market their bonds and decide to try green. They've got some really great people on staff there that were innovative who wanted to do it, but it was an experiment. No one really knew how it was going to go. They had to persuade their underwriters. There was resistance. However, the issuance was, quite oversubscribed, whereas the non-green bonds were undersubscribed. And they got international press. Treasurer Grossman's being, interviewed by Wall Street Journal. It went better than expected. And beyond that, it revealed that green branding and also the meaning behind it, funding green projects, attracts a different customer to the bond market, and perhaps one that may not have been interested in bonds before. So that's an exciting revelation for public finance officials who need to sell bonds and also fund green projects. I guess to sum it up, it's the right vehicle for the crisis, it's the right vehicle for the projects, and it's the right vehicle for the investors we need to move. As you sow's goal here is to raise awareness and get people to move their money, and we have issuers, investors, webinars coming up, and various things, but part of what I'm hoping comes out of this today is that I inspire some interest in investment and issuances here. That's about it.
Great. Thanks, Amelia. I really like that victory bonds. I think I'm going to only refer to green bonds as victory bonds from now on. So now we're going to jump gears to the public equity side, and for that we have Leo Dwyer here with us today. He's from Bloomberg, which is really exciting, one of the larger financial information providers of products to investment professionals in the world, and they're recently getting more involved here, as he'll discuss, looking at carbon and climate. Lee has more than 15 years experience in public equities and alternative investments. He's from across the pond in England, and a CFA charter holder. So Lee, I'll take it away.
Thanks very much. First of all, I want to thank Brett and 350 for inviting Bloomberg to be here. It's a privilege. I also want to thank Bob, our keynote speaker, because by mentioning the article, or the letter, I should say, that Mayor Bloomberg wrote, he kind of nicely gave me a little political cover today, so that's good. If the boss said it, I'm okay. And also some nice play in terms of some of the slides. There's an interesting thing for Bloomberg. So we say internally, well, actually probably externally as well, what's in Bloomberg's DNA, if you'll excuse the pun, is data, news, and analytics. And in terms of this particular panel, and this whole idea of I've divested, now what? You really need all of those elements. So that's why I'm grateful to be up here and contribute something to this discussion. For Bloomberg itself, ESG is something that we're very passionate about. We have an internal department. It's growing very nicely. We're constantly putting full-time resources towards that. We're also partnering with a lot of data providers. I don't think it's quite yet official. I don't think I'm talking out of turn, though, but Sustainalytics is going to be able to provide their data to our mutual clients through the terminal for analysis very shortly. So those are the kinds of things that Bloomberg is trying to do to expand the access to data and the coverage of data. And what we do when we approach this subject is we really start to think about it holistically, because we understand from your point of view, sitting, looking at your current portfolio, what your portfolio may become, there are all kinds of issues around data transparency and context and what-if scenarios. So that's really where we try and bring the aggregation of news with items like our carbon brief that's published on a weekly basis, but also access to the data, making that data transparent, using our own leverage with our corporate clients to pressure them to provide more data. All the data you find on the Bloomberg terminal at this point is provided and sourced directly from companies. We understand there's gaps in it. In 2000, if you think about the investable universe that Bloomberg thinks of in terms of public equity, so globally there's around 20,000 issues out there. And in 2000 we had ESG data, so that's the social and governance in addition to the environmental, data on about 1,000 companies. And as of now, we've got data on over 5,000 companies. So it's growing and it's starting, we're getting a little bit of that hockey stick. We're starting to get more data being provided, we're filling more gaps, and that's particularly exciting because it allows you to then run the analytics on it. So as we have this discussion, and what was absolutely fascinating for me this morning is thinking about items like attribution, where is your risk coming from, just tremendous slides around tracking error. Those are all the tools that people are using Bloomberg for in terms of understanding where their portfolio is sitting, how their portfolio is going to look if they switch out positions, if they, as Bob mentioned, divest over 5 years, how will those divestment decisions impact? How is that data that can then be fed up to the investment committee? How is it going to impact your investment policy statement? The overall approach is where Bloomberg is just an incredibly powerful tool, and we want to be active partners in that, which is why we've made acquisitions. Bloomberg New Energy Finance, I actually know from the guest list, there's more than a couple of clients of Bloomberg New Energy Finance who are using our valuation tools around things like wind energy to conduct valuation analysis on wind plants and feasibility studies on solar and identify some of the recent funding, who's sponsoring those events, the issuance of victory bonds. So those kinds of items are becoming prevalent on the terminal, and I'm excited to talk more about that, and also especially this afternoon in the panel. I'm particularly excited actually to be on the panel with Patrick, because I think there's a really tremendous segue there between the idea of data and analysis and number crunching, which hugely supports his point and also Bob's point about the data is just not there to support this idea that it's going to cost you money to divest, and I think that's particularly exciting.
Okay, thank you, Lee. So now we're going to turn to Dan Rosen, and Dan Rosen is the founder and CEO of Solar Mosaic, and that's founded here locally in the Bay Area. And for those of you who aren't familiar with Solar Mosaic, it's a funding mechanism for solar projects, which Dan will speak to. Solar Mosaic's not the first company that Dan's been involved. I'd say a serial entrepreneur. I've been involved with clean energy, energy efficiency, green building projects overseas as well in areas such as Israel and Native American communities. He's an Unreasonable Institute Fellow. Have to mention, being where we are, that he is a Brower Youth Award winner. And in, I guess, 2 years ago now, Dan was recognized as one of the 30 under 30 in energy by Forbes magazine as well. So Dan, please take it away.
Thanks. So, can you hear me? Thanks so much for having me to 350 and As You Sow. And I just wanted to mention before talking about Mosaic a little bit that it was Brett's birthday from 350 yesterday, who put on this event. And I was thinking that it would be really cool if one of the institutional investors here for his birthday could divest like $1 billion. So, any hands? All right. I don't know if that's illegal to even do that. Yeah. Anyone? Or you could just invest it in Mosaic. He takes it all. So, anyway, Mosaic is kind of, it's an interesting segue from green bonds to public equities to what Mosaic does. Mosaic, we see Mosaic as more of a marketplace and a platform that connects investors to clean energy projects and assets. We, in the kind of tradition of Lending Club and Kickstarter, see ourselves as a peer-to-peer platform where people can raise money and invest money, and really Mosaic is the fabric that kind of connects the grout of the mosaic that connects all these different pieces. And we named ourselves Mosaic because we crowdsource the financing. So there's many investors that come together, and that come together to fund solar projects. And there's kind of a poetry to that too, because if you look at solar projects, they kind of look like mosaics too, like little tiles. And at one point we even played around with calling our note a tile. That didn't really work, but it's this idea of many pieces coming together. And I remember, 7 years ago seeing Bill McKibben speak somewhere, and he said something like, "There's no silver bullet, but there's the silver buckshot." And I really love that idea of there's not one solution. We have to do it all. We have to do green bonds. We have to invest in the Teslas of the world. We have to invest in solar projects on schools and homes in our community, and we have to divest. So it's not like, hey, just this is the way to go. This is the highest leverage thing. I think there is a accumulation of a lot of solutions that are coming to bear right now that are reaching a certain scale, and it's really exciting to be on stage with folks that are doing these things. So to kind of dive into a little bit what Mosaic does, we finance now about $7 million of projects on our marketplace, which is a small number for folks in this room. That's a rounding error. But what's interesting about what Mosaic has done is we've done that from over 3,000 investors. The average investor on our platform has about $2,000 invested in the marketplace. The biggest investor has $250,000. And we just had our first wealth advisor who's now investing their clients' money invest yesterday. So we're starting to kind of branch out to bigger sums of money. But really for as little as $25, people can make a loan. And let's say that loan is on the same, it's pro rata, it's pari passu to someone who in that same loan made a $100,000 loan. So we're really trying to make it possible and lower the bar that more people can invest in this inevitable transition to clean energy. It started with a really simple idea, which was, taking kind of the extreme optimistic approach here. We see at Mosaic that the transition to the clean energy economy is actually inevitable, and it's actually happening a lot faster than a lot of people talk and think about it. Solar City, which is a big public company, one of the fastest growing solar companies, only started 7 years ago, and now they're worth $6 billion, and we've only done 1% of the electricity consumption in this country, but that's a very large denominator, right? But in technology curves, what happens in just looking at other technology curves, following Moore's law, and you follow the communications industry, is 1% is really the hardest number to get to. Once you get to 1%, it took us about 30 years. And in those 30 years, solar has dropped 99% in price. Since I was in high school, solar has dropped 10x in price. In that time to get to 1%, then it goes to 2%, then 4%. And if we continue the same growth curve, it's really only 7 doublings before we're at 100%. So no big deal, right? We think we're going to get there a lot faster, and the math actually points in that direction. And the Department of Energy, which is actually a funder of Mosaic, says that by the year 2016, which is not so far away, 2/3 of America's households will be cheaper. It'll be cheaper to put solar panels on those households than not. The problem with that statement is that is a tremendous amount of financing that is currently not sitting around the table. That is a significant problem that as the growth of the solar industry and the growth of the capital markets chasm as they are right now, we're expecting $1 trillion financing gaps for the solar industry. So companies like Solar City and SunPower are looking at doing enormously different and creative things, from green bonds to all sorts of different ideas, which is why Solar Mosaic has, even though we've only done $7 million, which is a small amount of money, we have ambitions to do a lot more of that, more than that, which is why it's gotten so much attention, because there are really, at the end of the day right now, 12 to 16 banks, sort of a cabal sitting around the table that are really putting significant money to work. So if you believe what I just said, that we are experiencing tremendous growth and there is capital constraint, that means one of two things can happen. One, those banks can double and triple and quintuple down, which, as you know, with Basel III and Dodd-Frank, is a really hard thing to do for banks right now. They're spending 50% of their time doing regulation. So that's not going to happen. Or more investors can come in the space, which brings us to investment versus divestment. I think the best divestment, one of the best divestments, is actually starting to invest in these clean energy assets. There are many banks who right now have less than 0.3% default in their portfolio. They're making great returns. It's a predictable revenue stream. You can almost predict it to the kilowatt hour what these projects are going to do. And if they don't do that, many companies have have performance guarantees and warranties and all those kinds of things. So if you structure the projects correctly, this is a great asset to invest in. There are projects that are not structured correctly, and we need to develop different standards and approaches to filtering those. But at the end of the day, a lot of people are making good money and in a risk-adjusted basis that outperforms other areas of their portfolio. And so Mosaic is going back to Mosaic, what Mosaic is doing is working to bring this to a lot more people. And right now we have 3,000 new people who have skin in the game, who are invested in our platform. We hope to bring that to hundreds of thousands. We hope to bring that to institutions and really make it easier. You mentioned taking a bond to a market can take as long as a year. We're hoping to cut that time down and to really eliminate the brick and mortar and paper pushing and all of the transactional costs in a solar project. Just to give you an example of the operational leverage I believe that we have over a bank, McKinsey just did a study on Lending Club, and they said McKinsey has, and Lending Club, are folks familiar with the Lending Club model? It's peer-to-peer for consumer loans. It's people refinancing their credit cards. They've done $3 billion in 5 years. It's peer-to-peer consumer lending. They have a 425 basis point structural advantage to a bank. And so that 425 basis points can be passed on to investors, it can be passed on to lenders, it can be passed on to borrowers. So, I see that the really exciting thing happening in solar finance is all the things that we're talking about, equity, bonds, all those things, but I see a whole new wave of, we'll call it financial innovation in this space that can be very, very powerful. You have renewable energy investment trusts, REITs happening. You have a lot of these new initiatives. You have Solar City just bought common assets. You're going to see people issuing bonds in sort of a not a bond market, but just connecting institutional investors to these pools of assets. And so, to kind of conclude, I think that we're going to see a lot of different approaches. There's not going to be one size fits all solution. And, the beginning, just to take it way back, the beginning of the Industrial Revolution and the current electricity grid started with Thomas Edison and J.P. Morgan Chase. J.P. Morgan Chase was the first investor in the utility industry. J.P. Morgan Chase is now the third largest company of any size in the world. GE, which is the heir of Mr. Edison, is now the second largest company in the world of any kind. J.P. Morgan is the third largest company of any kind in the world, or third largest. J.P. Morgan is the second largest financial institution in the world. GE is the third largest company of any kind in the world. So when new financial innovation comes together with new forms of energy, amazing things happen. I will not pretend to know I know what will happen, but I think that we're on the precipice of an amazing era. It's going to happen a lot faster, and you all should invest as much as you can as fast as possible in honor of Brett's birthday.
Great, thank you, Dana. Modern day J.P. Morgan here. So. Okay, great. So what I'm going to do is just dig in a little deeper and try to put some kind of meat on the bones of what it would mean to invest or use these tools to invest. And just a little bit, I think people are familiar, but the format is there'll be a lot of time in the afternoon to really dig in and get a lot of audience questions. So we'll have a few questions from the audience, but if you're really interested in the question for someone here on the panel, please write it down because you will have more opportunity in the afternoon for this question. So actually, Dan, maybe since we were just on the topic, I'll dig in a little bit with you first. This is a private investment, so it's not on a public exchange, but it really wouldn't be fair to call it like a venture capital. It's almost more like a debt instrument, right? There's a maturity, and maybe just lay out, if you invest, what's the investment?
Yeah, so since we're in California, I'll use an example of one of our California projects. So there's a project near Redding. It's a bee farm. And the developer there built a huge solar project, and it's actually through a feed-in tariff. So a lot of our projects are done mostly through the project being sold directly to the customer, either the homeowner or the school or whatever it is. So the biggest challenge of going solar, right, is the upfront cost of financing. Everyone knows that. So this project, I think, was I actually wrote down some notes here. 940 investors. The average investment size was $924, and it was an $868,000 loan. The way we've structured our loans are kind of typical to how they're done in the industry. I think this was a 1.25 debt service coverage ratio, so there's some room in case of the performance of the project is sub what it's projecting. This project also has a 12-year warranty, which is really kind of awesome. Not always the norm in the solar industry from Panasonic, because they are it's this new technology this new tracking technology that Panasonic has invested in. So it has a performance warranty, and it has a 5.5% yield over, I think, 12 years. And every month, investors are getting a monthly statement, their interest, and it's sent to their account. And that account, Mosaic, basically you can log into your account, you can take out your interest, you can invest it in more projects. Right now, the projects are illiquid. There's no secondary trading mechanism.
And how long would the investment be locked up for?
12 years.
Okay.
And so monthly, so it looks and smells a lot like a bond, if you will, because it's monthly payment. It looks a lot like a bond, but it's again not on a public. It's not on an exchange. But I do want to just say, even though it's not a private per se, we have some fundraisings going on our platform that are done through private raises, but that project was actually done as a registration with security. We have a shelf offering, so that's actually registered securities with, and we actually have a $100 million shelf offering with the state of California to be able to offer that to retail investors in California. So it is actually a security, which is, we've gone through the regulatory rigmarole, which is not insignificant for a startup. We've spent over $1 million of our startup capital to go through regulatory, because this model has not been done yet. I don't think it's any surprise to you that our financial system is not built for you to invest in the solar project on the school down the street. That's really hard to do, actually, as it turns out. I think JP Morgan today, actually, 99% of their assets are not in small businesses, yet 50% of our job growth and economic growth comes from small local businesses. So there's a challenge there in terms of how our financial system is regulated and how and doing what we want to do. And we found ways to do it, and we're developing scale paths. Lending Club, with this company that's probably going to go public this year. Google just made a $250 million investment. Is kind of the trailblazer in the peer-to-peer space, and we're kind of following their code.
Great. And then with the credit worthiness of that investment, is that really dependent on the bee farmer in Reading, or how does that work?
Yeah. So it is the most important credit piece is the off-taker. In this case, it's PG&E, which because it's a feed-in tariff, PG&E is buying the project for 20 years, buying the power from the project for 20 years, which it's an interesting experiment having 900 people in a project that PG&E is interconnecting and dragging their feet on. I don't know if anyone. It brings the whole crisis of how developers deal with day in and day out to 900 people when they're wanting their loan to fund. They're like, well, we're sorry, PG&E is not interconnecting it this week. So
great. Yeah. And sorry, just to build off of that, it's interesting. We have a lot of individual, but also institutional investors here, and it seems like, isn't it just easier for PG&E just to go to a big pool of capital like an institutional investor? But in your case, that's really not what Mosaic was set up to do. It was targeting, smaller investors. And I guess, what was the rationale? Why is it important for smaller investors to participate, or do you see yourself moving up into larger investors as time goes on?
Yeah, well, again, we see ourselves as a technology platform that connects investors to projects, and so that investor could be a $25 investor that wants to put in project in their school. That could also be a $25 million pension fund that wants to. We just think we have a very efficient origination platform or a very efficient investment platform. The important retail story for me is that I think there is an amazing thing that's happening in distributed generation and in distributed finance. Kickstarter, as an example, when they started, people were like, well, how is this really going to scale? People raising money from their community, and how does this really get off the ground? Kickstarter 2 years ago did as much as the National Endowment of the Arts in 1 year. And now they're doing as much as 5 to 10 times this year as the National Endowment of the Arts. So when you empower people with these tools that have been centralized and kept out of their hands for a long time, and you give them those tools through the internet, which is a beautiful medium for empowering people, I think wonderful things can happen. There are $5.4 trillion sitting in people's IRA account, not doing that much. So if we can figure out a way to connect these underutilized assets and these underutilized investments and connect them to projects that are worth funding and that are good, I think we can actually move a lot of money. And so we believe that, and we're gonna stick to the retail investment, even though we are seeing now institutional investors approach us and say, hey, 6% yield on these projects, and we're looking to put 5% of our investors' money into alternative assets, into sustainable assets. We don't really like the screened assets thing. We want to really, this client really actually wants to invest in solar. We see that and hear that a lot, and we're working to build that solution. I think actually, if I was to make one kind of like slightly provocative statement, is some of the screens and divestment stuff are for some investors are not doing enough. There are people who actually want to see the impact, see that tangibility, and really go big in clean energy. It might not be just enough to say we're not doing fossil fuels. Some people actually want to invest in renewables. And there's not you should be annoyed at Mosaic. Totally fair. We haven't registered yet in Massachusetts. We're just getting started. Okay. Understood. So in Massachusetts, for us to go through and go forth and do it in many states, which we will eventually do, we're going to have to go into a much more robust regulatory, and that's going to cost us a tremendous amount of resources. And we've actually kicked off that process, and we're working on that. You should really be annoyed not only at Mosaic. If I could also offer another shoulder to be annoyed at is the Securities and Exchange Commission. I think it's a double-edged sword in the sense that the Securities and Exchange Commission was created to protect widows and orphans after the Great Depression from basically bad actors, and that's really important that we have those standards. But it's that classic kind of regulatory framework that if it doesn't look and smell like this, then it doesn't work. It's every to hammer every problem with like a nail. And so we need new regulation. In the UK and other countries, they're starting to expand crowdfunding and doing it for small businesses and things like that. And they're going to get way ahead of us because the banks, there's a constriction of capital. We need to unlock this pool of capital that is here in this room, that is everywhere. And there's currently formidable barriers to it.
Great. Yeah, thank you, Dan. So, Lee, I wanted to talk to you a little bit about, and Dan, you actually had a good segue a moment ago about, measuring and wanting to be able to feel that impact. So I know environmental screening for public equities has been done for a number of years, but it's getting much more sophisticated in terms of being able to measure and being able to look at that. And I know Bloomberg's terminals in just the last couple of years have really, the information and what you can do in terms of portfolio construction, and it has really grown by leaps and bounds. So Lee, can you talk a little bit about what can you quantify in terms of if you want to look at an environmental or climate related factor, if you're looking at a company or you're looking at a portfolio, how can you measure that? Where do you have the best data to quantify?
Yeah, absolutely. So what's interesting is when it comes to data, so there's a problem out there that we face, that data isn't necessarily transparent enough, and there may not necessarily be enough of it. So there are gaps still, admittedly. But currently, Bloomberg's collecting data on more than 100 separate data points, and then also multiple themes. So you can combine the idea of data collection and themes and put those into now analytical tools. So whether you're negatively screening using screening functionality to deselect, to get out of fossil fuels, to just to the point earlier, to get out of the 134 companies that are in a particular industry set, or whether you're thinking about the reinvestment and understanding the companies that you're looking at and where those data sets are. There's been a breakthrough over the last few years that now allows you to take that fundamental data set, right? So each one of these single data points, of which there are north of 100, whether it's GHG or whether it's a ratio, GHG to sales, or whether it's something on a more social aspect, number of women in directorship positions, whether it's something around water usage as a percentage of assets, which however you want to slice and dice that fundamental data set, you can now screen on it. You can actually run a back test and extract the impact of that data. And this is really getting to that point, not to just want to harp on one thing that Patrick said, but I find it particularly interesting that we might not yet be at a place where we can prove that making these decisions is going to make me money. But we can get really close, if not definitively, prove that it hasn't cost me. And you can now start screening on those environmental data sets around your universe, whether it's the MSCI All Country World Index, a couple of thousand companies, and screen based off of those environmental factors. And it's almost a plug-and-play application now. That you can put those environmental factors in, you can separate them from everything else, and then understand whether or not they impacted your performance in a negative way or a positive way. And then that has the power of creating scoring models and how you can then have that impact your investment decisions. And when you make those reinvestment decisions, what are the elements that you want to focus on? What are the companies that have supply chains that meet your criteria and have environmental data points that are positive and feel empowered about those investment decisions? So that's the big shift that's occurred really in the last couple of years. Not to plug a function, within Bloomberg, it's all kind of function driven. Some of you are Bloomberg clients. So we have a fundamental factor model that you're able to take those fundamental factors, of which there are tens of thousands and now hundreds of environmental items or social items or governance items, and actually quantify the impact of those in terms of your performance and produce charts like the ones that gratefully you guys put up there for me, that when you select positively towards those factors, you can demonstrate some outperformance. So I think that's the big breakthrough, is making that data available and really interactive.
And are you finding, I don't know when exactly the data in terms of the launch, but have you got any feedback either from portfolio managers using the data as constructing portfolios, or from institutional investors asking their managers to start to incorporate ESG? Are people using the functions and any feedback? Is it more investor driven? Is it more driven from PMs wanting the feature? Yeah,
most certainly. So there are two elements to that question, I think, the way I think of it. So in terms of us gathering data, right? So there are kind of three drivers for us gathering data and being somewhat motivated by it. The first is just regulation, and that's relatively simple. We know it exists. The second is what I think of as like public regulation. So people like yourselves that are requiring and demanding that kind of data from companies, and that's driving the collection. And then, of course, the sister to that, or the close cousin, is the usage of that data. So just anecdotally, my role as a market specialist on the equity side is I interact with a vast majority of Bloomberg's clients in the western half of the United States and Canada. Some of our clients are the culprits in what we're discussing here. In fact, nearly everybody, actually probably everybody on that top 10 list or their bottom 10 list is a client of Bloomberg. They're using it for their commodities and energy trading, all kinds of things. But we're also interacting with portfolio managers who are absolutely, to your point, demanding this kind of information and analysis. There are people in this room, public pensions, that have G departments, governance departments. They have environmental departments that are digesting our information and the other providers that are out there. It's a frequent question. I see requests for understanding about the data, how they can incorporate it into their screens, how they can incorporate it into their portfolio analytics. So that's kind of anecdotal, right? I hear those questions a lot. I believe, and don't quote me on this, but I believe usage around ESG data within the firm is growing at about 14% annually in terms of the amount of people that are consuming it. So that's exciting if you take the analogy of how quickly become very pervasive on the system and drive demand.
That's fantastic. Thank you, Lee. So Amelia, just wanted to dig in a little bit more on the green bond. So you gave an example of Massachusetts state doing a green bond. Do you know what other entities do? Are you seeing corporates? There's another subsection of bonds. You also see, larger national organizations. Who all is issuing green bonds?
It's changing quickly, and the field is growing also quickly. But corporations are now issuing green bonds, as well as institutional World Banks type things, and as well as smaller organizations. It's coming from a lot of angles at this point, and you have most categories of bonds. You've got municipal bonds, you've got corporate debt, you've also got, I heard of a mortgage-backed security for net zero homes that would back that kind of bond. So it's an exciting growing field, and major issuers in the past have been, this year the exciting one that got a lot of press was Berkshire Hathaway. They didn't call their bond a green bond, but it funded one of the largest solar projects in the U.S. that is in California, Solar Star, I believe. And that was the second bond that their utility, Mid-American, had issued to fund solar projects. So that's an example of a non-marketed bond. It's a bond that funds a sustainable project that is not called green. Additionally, EDF, that's one of the largest power companies in France. They issued $1.4 billion euro bond to fund renewable energy. Bank of America is issued a $500 million green bond to fund projects their clients are doing that are sustainable and green, and as well as IFC, World Bank. They're some of the major actors and first actors in this market. IFC's got $3 billion as a program total in green bonds, and the World Bank has $4 billion in total, and they keep cranking them out. Last year, IFC issued 2, which was really exciting. And
great. And then just maybe to be a little bit cynical, right? What if someone was going to look at these green bonds really just kind of greenwash bonds, right? So it's more kind of marketing and PR, and not so much measurement and a change. Maybe the root of that is really just being able to document what the bond is doing. But do you have any kind of feelings about that? Do you think that these green bonds really are significantly different than the other bonds that were issued in the past?
I would say that greenwashing is the primary threat to this growing market. I mean, you really don't want a coal company to issue a bond for clean coal. That's going to be troublesome and will hurt the credit and confidence associated with these new assets. So what you're seeing is a rush in competition to create standards and metrics to allow bonds to be compared apples to apples to non-green bonds or brown bonds, as some people call them. So that's what the guidance principles were about last week. Some of the biggest banks in the world came together to form these principles. They want to trade them. They want to have common metrics that are transparent. And right now, it's unclear kind of what exactly. It's up to the issuer at this point. There's no rules or laws. It's not regulated outside of how bonds are typically regulated. Massachusetts did run into this. They hadn't picked projects to fund with their bonds. They raised the money, and then they got investors saying, hey, what is this going to go towards, by the way? And so it became very clear very quickly that you really need to have that transparency up front. So I'd say that's the biggest sticking point right now, I would think, in the green bond market.
Great. And then I would say, just kind of being in the space, if there was one other hot area right now, other than green bonds, you've got your Google alerts. The other place you get a lot of Google alerts would be social impact bonds. And some of you might have heard there was maybe the Goldman Sachs bond in New York got the most coverage, where the payment you actually get on your bond depends on how many folks that are getting rehabilitated out of prison go back to prison. So you really have this social impact that's tied into the return. And, what was that? Which Bloomberg person guaranteed?
No, the company, the job.
Okay, great. So, maybe have you heard anything about doing something similar with environmental metrics, essentially having an environmental impact bond where reducing greenhouse gas emissions or some other environmental impact would have an influence on what the rate of return was?
Well, just to start out, for those who don't know, a social impact bond, the way it works is that for a problem, the government pays a lot of money to fix and can quantify. A third party comes and volunteers to try to do it better. And another third party funds their ability to do it better. Investors fund the third party, and then the bond pays out depending on how much more cheaply they can accomplish the social project than the government can. In that case, the government pays back the investors. So in the case of green bonds and climate, part of that issue is that we haven't quantified, the government hasn't quantified this problem as successfully as they have recidivism. They know exactly how much each of those convicts cost them once they have to be readmitted to jail if that's necessary. So part of the issue that makes it not a great fit yet is that there's not enough metrics to tell the government to realize kind of what the level of payment would be, for example. However, you could imagine a number of ways you could use social impact bonds because they're a great means of experimentation. And the government doesn't take on any risk setting up a social impact bond. They only pay out if they are vested by this third party, which is what you want them to be. So I haven't heard of any projects specifically, but I think people are thinking about this. And you can imagine a third party or a solar mosaic saying, hey, we can solve this environmental problem for you. Let's give that a shot. Pay us when we do it better. That's completely feasible, even though I'm not aware of examples.
Okay, great. Well, I think we're wrapping up and ready for questions. Maybe my big closing, I never introduced myself. So I'm Will Lawn. I'm with Trillium Asset Management, and we've been a ESG specialist for 30 years. We work with a variety of advisors and institutions on investing and have helped a variety of investors do both partial and full divestments. But I think we probably should wrap it. I know lunch is a very popular time of day, but I hope everyone learned something about a new, really green reinvestment option. And please thank the panelists.